So I think, as you mentioned, the story in credit, we have seen spreads tighten and continue to tighten to historically very snug levels. And so from here, I think the argument for credit is a carry one. It's an income one. You want to be in credit to earn yield. Yields are still at historically high levels. And so our main recommendation is to earn carry through some of the lower volatility parts of the market.
So, Meghan, do I stay in investment grade, or do I maybe venture out a little bit into the high yield space? Again, if I look back to performance in 2023, high yield was the place to be, and that kind of surprised me given all the talk about pending recessions and all that kind of stuff.
Yeah, so I think that there's opportunities both in investment grade and in leveraged credit. So within investment grade, we really like the 3 to 7 year part of the curve. We also like taking risk into triple Bs, so the lowest credit rating within investment grade. We have a thesis of a credit soft landing, and we think that area of the market, you're getting a pickup in spread and should still perform well this year. Over in the high yield market, we think you need to be more selective. So between leveraged credit, we actually like leveraged loans right now, double B leveraged loans, which offer a pickup relative to high yield, both on spread and on yield. And so within the lev fin space, we're overweight the loan market right now.
Meghan, last week somebody had a great chart out on yield to worst. Folks, this is one of the best Bloomberg series. It's the aggregate yield to worst series, and it goes back before Volcker. And the answer, Meghan, is we're out 3 standard deviations. We've seen a massive balloon in yields up to an aggregate yield to worst of 5.25% worldwide. Have we reached escape velocity off of the Volcker disinflation that we've seen? Are we in a new regime?
So I think that we are in an elevated yield regime. So for example, our rate strategists are calling for higher long end yields. So we're thinking of a midpoint around 4.5% on the 10-year, and compared to historical cycles, we see less room for long end yields to rally if we do slow down, given a lot of the structural issues at play, fiscal deficits, and further treasury issuance. So I do think that higher yields are here to stay for some time in this cycle.